Has the pandemic caused you to rethink your retirement plans? Following a year of market volatility, there's still an uncertain outlook ahead, making it even harder for today's retirement savers to make plans for the future. Certainly, the plunge in markets last spring was a rude awakening. With so many more people keeping their pensions invested for longer via drawdown plans, diversifying and learning how to manage volatility are important lessons. We really hope that the highlights from the FT's Digital Dialogues event about reinventing retirement will help you plan for your retirement journey in the future. Our panel of experts, led by Sir Steve Webb, the former Pensions Minister, will explore how paths to retirement are changing and provide practical insight into managing the risks and using cash flow modelling to find an answer to the eternal question, how much is enough to retire on? Whether you're an individual saving for retirement or somebody working within the advisory profession, you'll enjoy this video. And don't forget, there are dozens of free to read articles all about retirement on Next Act, the FT's retirement hub.
We're still only beginning to see the start of what pension freedoms actually mean. People perhaps in their late 50s making choices, but what we don't really know is what those choices should be later into retirement. Maybe buying an annuity in your 50s doesn't make sense, but perhaps you should do it in your 70s. So I still think it's very early days. Was it Gandhi or someone who was asked what he thought about Western civilization? He thought it would be, it's too early to say or something like that. The pension freedom is very much new. And then the pandemic comes on top of that, and suddenly people who've been staying invested rather than buying an annuity or having a DB pension, much more exposed to the stock market than in the past. I think there are a lot of lessons to be learned on, even just on what's happened this year in terms of diversification, not overreacting to market swings and so on. So we're in a time of great change. I don't think we're anywhere near a settled place yet.
Retirement is no longer a particular birthday or a round number birthday, your 60th or 65th, that you may have been targeting when you first started work or expected because that's what your work pension scheme have. For more and more people, it's very much a transition, and it could be up to a 20-year transition from their mid-50s perhaps to their mid-70s, as Steve said, perhaps culminating in buying an annuity. So that's the big change, because it's not a single point that they're aiming at. It's a period of time, and that period of time may be different economies. The pandemic is an event that may come, or other events. If we look back 20 years, we've had a financial crisis and a technology crash, and then also different governments, which may bring in different rules. So there's a lot to manage in a 20-year process rather than just aiming for a single day.
Most of the people I hear are worried about how they're going to pay for their retirement. It is a real panic, and especially those who are now facing redundancy, they may have to become self-employed. There's no employer contribution. It is really bad news for an awful lot of people, for millions of people.
There's an awful lot of people going for either annuity or drawdown. It seems that it's rarely a bit of both. And I think the pandemic has brought people's change, or started to change people's mindset a little bit. Cash flow modelling has become much more popular and, in fact, commonplace with most advisor businesses. And diversification has become far more important. But also, retirement income isn't just about pensions. It's about all your assets in retirement, whether that's using your ISAs or your equity release or whatever, to provide an efficient and regular stream of income. But most important, tax efficient as well as secure.
Let me give you a nice simple way of thinking about this. What are you trying to achieve in retirement is maintain your standard of living when you haven't got a wage. You don't want to stop work and suddenly be eating cat food. Yeah, you want to almost not notice. So what you have in retirement's got to relate to what you had in work. And a rule of thumb is about 2/3. It could be less, could be more, but once you've stopped paid work, you're not paying national insurance anymore. You may or may not have paid off your mortgage, but let's suppose you have. You haven't got travel to work costs, childcare costs. So you don't need the same amount. So let's say 2/3. National average wage for round numbers is 27,000 a year, and you'll get 1/3 of that from the state. So you can go on the website, check your state pension thing, and the answer is usually about 9,000 these days. It may vary, but roughly 9,000. So that's half of the 18,000 that you need, your 2/3. So that other 9,000 has got to come from a pot, and let's assume you're saving in a pot of money pension. Well, how do you get 9,000 from a pot? My rule of thumb, here we go, is £1,000 of pot gives you £1 a week of income. Okay? £1,000 a pot gives you, now that's a sort of annuity calculation. So if you want £9,000 a year, £180 a week, that would imply £180,000 pot. That's my kind of fact bucket calculation. So let's say 200,000 for round numbers sake. So someone on an average wage who's going to get a full state pension sort of needs 200,000 pot to have a decent standard of living in retirement. So you can look at what you've already built up, see what you're short of. If you're in a workplace pension, crucial thing, get what your employer will put in. And in particular, max out on what your employer will put in, because often the employer will put a minimum amount in, but then if you put an extra pound in, they'll put an extra pound in. And there is no investment advice better than take free money when it's going.
I think that's the key word, volatility. When we're talking about retirement, the greatest risks are actually probably how long somebody lives and what future inflation might be, because I'm sure they don't plan to go back to work. So they need to make sure what they've got will cover them for this year and next year, but also many years ahead. And there is a trend that people underestimate their life expectancy, or they look at life expectancy at birth rather than life expectancy at retirement age, which is obviously a little bit older. In terms of client experiences, actually, our clients found that things weren't as bad as they perhaps feared. It's a very scary pandemic. The news is very concerning, but actually, if you have a balanced portfolio, you're well diversified, you shouldn't have suffered huge losses, even in March and April. And if you are diversified, as Nick said, across countries, you maybe haven't done too poorly. Some of this is easier to say when markets have largely recovered, but it is a good reminder about having cash, and as low as cash interest rates are, to have a year or maybe two in cash to cover a withdrawal, that you don't have to touch your portfolio, you don't have to draw on assets that may have fallen. Just shows how important that is, and to think of cash as an insurance against these kind of events, not just an asset with a low return. When clients look for advisors, they rarely look for somebody to manage their behaviors or control their emotions. That's not what they type into Google, but it is often what they need most and what they value most when they've worked with an advisor.
A lot of people are just stopping paying their pension contributions because they say, I can't budget for it. And I wish there was more than pension wise, where people could have a general education to get their budget sorted so that they can still pay into a pension, so they can look at what they might get. They don't understand the charges. They don't understand what an influence the charges they are paying on their pension contributions are on the final result. It can be mega differences. They don't understand that if they take their pension early and then get back into work, that they are limited with only putting $4,000 a year into their pension. So they've really scuppered their retirement income. There's so many, it's so complicated now. If only we had a general, well, financial education, but a general pensions education that answered all the basic points. It used to be a small booklet that said, you retire at this age, you'll get 2/3 of your income, di-da. Now people really are lost.
We use cash flow modeling in two main ways. One, when we first take on clients who are looking ahead to their retirement, and what we want to make sure is that we know what assets they've got, we know what incomes they've got, but most importantly, what retirement they have planned, is understanding what they've been looking forward to, what they've perhaps been missing out on, who they want to help, and perhaps when that will be. So there's a lot to factor in. So it's quite a personal discussion first, but then the cash flow modeling comes in to look at, well, okay, what do we need to do to achieve that? And what are the risks and what are the assumptions? So we make some assumptions about whether they'll keep working, whether they'll get pay rises, what the growth rate of the investments might be, and what inflation is. We tend to be on the pessimistic side, because if you're too bullish, there's nothing you can do when you get to retirement if it's gone wrong. So we are a little bit cautious. And we also then look at what if something goes wrong? We didn't quite forecast a pandemic, but what if someone loses their job because of illness? What if someone's business fails earlier than they had expected to sell it, perhaps? So we're looking at the risks to their plan. Once in retirement, we're looking to make sure that the money they're drawing is going to last, and how long they may live, and is it sustainable? So it's a very good tool. It's not factual, it's a guide and it's an assumption, but it's a very good tool to see whether people are on track, and for some to know whether they can finally retire and they've got enough to, and they can choose to keep working if they wish to.
I think you can alter plans, but I think the key to cash flow planning is working out what your guaranteed or bills, your commitments, your must-haves, the essentials, and making sure those are covered in some form of insurances or secure income. So maybe you don't have to take the income from the cash fund that we were talking about earlier. But being able to split those down really does start helping the advisor work better with the client. The client starts opening up and starts talking about different things. They may well have forgotten they've got this policy or that policy. It's a really good way of turning the traditional fact find into a very detailed plan. And that, is fine for as soon as you set it up, but it will change as you get these global events. But it really makes it very easy for the advisor to explain the recommendations, and sometimes the recommendation almost comes out of the cash flow. So it's a really good tool, and I would encourage everybody to either have a go themselves or speak to their advisor and do it, because it really is a way of understanding your financial position much more, and whether that means you need to commit more or cut down. It's a really clever way, and then that comes on to the tax efficiency as well. There's no point in having huge amounts of wealth if you end up giving half of it to the tax man. And we have seen plenty of people access their pensions in one lump sum, paying 40-45% tax, which is just a real shame, because I'm sure people wouldn't do that deliberately. It's just they've seen the access is available for the fund, and they've taken it and haven't taken advice or haven't gone to Moneywise.
Yeah, I think the key word is, for me, and when I work with our clients, is cash flow rather than necessarily income. Having worked maybe for 40 or 50 years, we've probably been driven by the income we earn because we receive that pay or dividend from our business, and then we pay for our lifestyle. But actually, for a lot of people, when they enter retirement, it's a withdrawing cash flow generated from their assets. So it's not necessarily the rental income on the buy-to-let, it's selling the buy-to-let because the proceeds will fund the next 5 years of retirement, or it's gradually withdrawing the ISA, the actual capital maybe, rather than the income it generates. So you talked about the dividends suddenly stopping this year. If you're relying on dividends or you're relying on bank interest, then there's no way you can really go if that is zero or stopped. So it's very much seeing your total wealth as a pot, and then how you draw that cash. And so a lot of the work I do is the sequence of that income. What's the right money to take first? How do we maybe reduce risk? How do we maybe keep assets inside or outside the estate? Because it could be that for a lot of people, their pensions become something that is a legacy they pass on, but they spend the money that they have in their ISAs to fund their retirement. And that can be quite jarring for somebody who's looked at their pension for 30 years and expected that's how they'll spend their retirement. When it comes to things like products, annuities, then that's very much about making sure you've got the certainty that Nick touched on earlier, is if when you first enter retirement, you want to make sure that your certain bills are covered, that even if investments you've got go wrong, you will still be okay. Or as Steve said earlier, maybe toward the end of life, when you no longer want to worry about your investments, you don't want to keep meeting with an advisor, you just want to secure your income for the rest of your life. And annuities are a good time to do that. It's also remembering when state pension comes in. So if you're retiring in your 50s, it could be 10 years until your state pension comes in. So maybe you need something on a temporary basis until that comes in at 66 or 7 or 8.
The context, obviously, as a chancellor who has a huge budget deficit to fill and a manifesto saying he won't raise the headline rates of income tax, national insurance and VAT. So where's he going to look? He's going to look at wealth taxes, he's going to look at tax relief. So I think there is no doubt that these are on. I seem to recall every budget, every spending review, we would start in a government department with a long list, and you can be darn sure these sorts of things are on the long lists. So when you read in the newspapers that the Treasury is considering, well, of course they are, because they're always on the long list. In terms of specifics, the inheritance tax and all the treatment of pensions on death that George Osborne brought in could easily be reversed. I think it was quite surprising when he did it. It's a perk. Few people would understand it. There wouldn't be, people wouldn't be marching down Whitehall with placards demanding the reinstatement of favourable tax treatment for pensions on death. So I think that is time limited. That could end. In terms of tax relief more generally, I mean, we always hear, they're going to abolish high rate relief and scrap tax-free cash, and the politics of it is pretty grim, because to raise serious money, you're taking thousands of pounds off millions of people. I think the best guess would be salami slicing, which is what we've seen in the last decade. So they don't do something wholesale, but they'll cap a limit here, shave something off there. So on tax-free cash, it would be astonishing if they just abolished tax-free cash, but they might say, from now on, you can't add to the pot more than so much a year, or it's capped at this figure, or, the annual allowance can only be carried forward 1 year, not 3. So an awful lot of kind of niggly stuff that the public will switch off during the budget statement, but mysteriously raise $1 billion here and $1 billion there. That would be my best guess.
I really hope that you enjoyed watching the highlights from our event, and remember, there really are as many different routes to retirement nowadays as there are people retiring. Everybody's own personal journey is going to be somewhat different from the next person's, but lots of tips and practical advice there from the experts to take away. Now, if you need a little bit more inspiration, then don't forget you can go to the Next Act, the FT's free retirement hub, where you can access a wealth of information and free to read online articles about everything from how to manage your assets after a divorce to where to find a financial advisor. See you back here soon.